Better than expected results on the top and bottom line, Scott. We have revenues of $867 million, beating estimates of $802 million. Earnings, a loss of $1.70 per share versus $1.73 loss that was expected. Guidance also coming in strong. The company is saying it sees first quarter revenues of $700 million versus the $691 million that analysts had expected. And then that active account number, the company is saying 70 million active accounts. That's the number they actually announced in January. But in this letter to shareholders, the company says, despite a difficult macro environment, we made excellent progress building out our platform, brand, and industry leadership with the addition of nearly 10 million new active accounts. And they talk a little bit about the first quarter outlook, saying they're committed to a path that delivers positive adjusted EBITDA for full year 2024. So talking about seasonality and some broader challenges here, but committing to a path towards profitability. Scott.
All right, Julia, thank you. You come back on as needed. So high growth, unprofitable tech, 1 for 1 in overtime. We'll see what happens as we're still waiting on Twilio and Zillow and Shopify. Let me get to the other part of what Marco was talking about with you, this rates equity disconnect. The idea that rates have moved closer to where the Fed is talking about, but that the stock market continues to move higher. Do you see it as a disconnect too? Does the stock market need a bit of a reality check or not?
I want to be careful how I frame this. I think rates should be higher. The 2-year is not right. That's been something that a lot of people, myself included, have mentioned, and I think that's still the case. It is unusual to see the 2-year meaningfully lower than the Fed funds rate unless you're close to a reduction in rates, which we are not. So I think the 2-year should certainly go higher. You could probably make the case that long-term rates need to be higher as well. Are equity markets ignoring that? I mean, listen, it's very difficult. This is an incredibly confusing environment right now.
That's right.
Because on the one hand, you can say, yeah, they're ignoring this. On the other hand, they could look at the NAHB survey today, the National Association for Home Builders, where sentiment improved for the second month in a row. You can look at the retail sales report, which was a blowout. Obviously, we don't want to make large decisions from one report, and we should smooth the last few. But the consumer continues to hold up well. So if you're an equity investor or if you're the broad market, you have meaningful positives on which you can latch, including something we mentioned previously, the lack of a recession in Europe and the reopening in China.